Welcome to the deep dive. We're jumping right in today, looking at some really powerful source material about personal finance. Stuff that's, frankly, shifted how millions think about money.
That's right. We've got notes here contrasting two very, very different paths to wealth, or, well, the lack of it.
And our goal, our mission for this deep dive, is to unpack why. Why do the rich seem to operate on a completely different financial wavelength?
It really boils down to this core story, this narrative device from the material, the two dads. It's powerful because it forces you right away to question what you think you know.
Yeah, you got the poor dad, smart guy, highly educated, PhDs, the works, but always, struggling with money.
Mm-hmm. And then there's the rich dad, didn't even finish 8th grade.
Right. But ended up one of the wealthiest people around, so it clearly wasn't about grades or degrees.
Not at all. It was about their fundamental view of money, their philosophy almost.
And the contrasts are stark, like poor dad saying the love of money is the root of all evil. Classic advice.
Very traditional. But rich dad, he flipped it completely. He said, the lack of money is the root of all evil.
Wow. Okay, that shifts the focus immediately. It's not about morality anymore. It's about practicality.
Exactly. And their practical advice followed that split. Educated dad said what we all hear. Study hard, get good grades, find a good, safe company to work for.
The secure path, benefits, stability, all that.
Yep. Rich dad's advice sounded, well, almost wild. He said, study hard so you can find a good company to buy.
To buy it, not work for it. Okay, that's the whole game right there, isn't it?
That's the core of this deep dive. How does someone even get to the mindset of buying the company versus just wanting a job there? It starts with mental habits.
The source material really hammers this point. Your financial reality starts with your internal dialogue. And there's one specific phrase that apparently just shuts down your brain's wealth potential.
Oh, yeah. It's deadly simple. I can't afford it. The moment you say that, or even think it, well, your brain just stops looking for solutions. It's like giving up before you start. Rich Dad apparently hated that phrase.
So what was the alternative? You can't just buy everything.
No, not at all. The alternative was to change the statement into a question. Okay, how can I afford it?
Okay, from a dead end to a challenge.
Precisely. It forces your brain to engage, to problem solve, to get creative. Rich Dad said it makes your mind stronger every day. It becomes a mental workout.
That connects directly to what the source calls the school trap, doesn't it? How really smart, highly educated people often end up financially stressed.
It does. Think doctors, lawyers, accountants. They spend years mastering complex professional skills. Schools are brilliant at teaching those.
Skills that let them earn a high income, presumably.
Absolutely. They learn how to make money. But the piece that's often missing, the piece schools don't teach, is financial literacy.
Meaning, what to actually do with the money once you make it.
Exactly. How to keep it, how to protect it from, say, taxes or lawsuits, and critically, how to make that money start working for you instead of you always working for it.
So you're saying specialization gets you the income, but you need broader financial skills to build wealth. Is that it?
That's a great way to put it. Poor dad pushed specialization. Get good grades, find that safe job with benefits. Security focused.
While Rich Dad pushed for understanding the system of money, like how it actually works.
All right, understanding money, investing, basic accounting, even law. He wasn't aiming to be an employee. He was aiming to own the system. He wanted money to work hard for him.
Okay, so if you want money working for you, you need to know where it's going, like keeping score.
You absolutely do. And that leads us straight into what the source calls rule number 1. It's the absolute foundation.
Which is?
You must know the difference between an asset and a liability, and then crucially, you must acquire assets.
Sounds simple, maybe too simple, but the material argues this is where most people, especially middle class, get tripped up.
They do. And we can't use dictionary definitions here. It's all about cash flow. That's the key insight.
Okay, define them using cash flow then.
An asset is anything that puts money in your pocket. Think of an arrow pointing EN towards you.
Got it. Money coming in.
And a liability is anything that takes money out of your pocket. The cash flow arrow points OUT.
Out, away from me. Simple visual.
Okay, but that simple distinction, it reveals the huge illusion the middle class lives under. They buy things they think are assets.
Like what? What's the big example?
The family home, your house.
Whoa, okay. That's going to rattle some listeners. The house is usually the biggest investment people make. Their main asset.
That's the common belief. But Rich Dad viewed his own home purely as a liability. Why? Because which way does the cash flow?
Well, you've got the mortgage payment, property taxes, Insurance, stock repairs. Yeah, it's all going up.
Exactly. Money flows OUT every single month. It feeds the expense column. So based on the cash flow definition, your personal residence is a liability, not an asset.
Unless you're renting it out, maybe,
Yep.
then it generates income.
Then it could become an asset, yes. But the house you live in, liability. And if that's your biggest investment, the source says you're likely in financial trouble.
Okay, I see the logic now. It's purely about which way the money moves.
And once you see that, the financial patterns of different groups become incredibly clear. It's like reading a story told by numbers.
So, the poor. How does their story look?
Very simple. Income comes in from a job, and it goes straight out to cover basic living expenses. Rent, food, taxes, transportation. Income basically equals expenses, survival mode.
Okay, and the middle class.
Their story is more complicated and often more precarious. Income comes in, usually higher than the poor, but then it goes out to cover not just expenses, but also all the liabilities they've acquired thinking they were assets.
The mortgage, the car loans, credit card debt.
Right. All those payments increase their monthly outflow, so even with a good salary, they're often living paycheck to paycheck, trapped by the need to service those liabilities.
Which keeps them dependent on the job.
Completely.
Yeah.
Now compare that to the rich.
How does their cash flow pattern differ?
Their income doesn't primarily come from a salary. It flows from their asset column.
Things like rental properties,
Yeah.
stock dividends, business income.
Exactly. Royalties, notes, income-generating assets. And crucially, the income from these assets is usually far greater than their expenses.
And the surplus, what do they do with that?
They buy more assets, which
Yeah.
generate more income, which buys more assets. It's a virtuous cycle of wealth accumulation. They're not just spending the extra money.
Okay, so the middle class acquires liabilities that look like assets,
Yeah.
while the rich acquire true income-producing assets.
That's the fundamental difference. And that middle class pattern, work hard, earn money, pay bills, maybe buy some liabilities, need more money, work harder. That's what the source calls the rat race.
The hamster wheel.
Yeah.
Makes sense. And the material says it's driven by emotions.
Two very powerful ones, fear and greed.
Oh, so.
Fear is the big one. The fear of not being able to pay your bills. That fear keeps people waking up, going to jobs they might even hate just to get that paycheck. It keeps them compliant.
Okay, fear keeps them running. What about greed?
Well, maybe greed is a strong word. Maybe it's just desire. But when they do get a raise, what happens?
They usually spend more. Bigger house, nicer car.
Exactly. The desire for more kicks in. They increase their spending, often taking on bigger liabilities, which ironically just increases the fear of not being able to pay the new, higher bills.
So the fear and desire just feed off each other, keeping them stuck on the wheel.
Yeah.
Slaves to the paycheck.
Slaves to money, as the source puts it. Because they work for money, they don't understand how to make money work for them. And who benefits most from their labor?
Well, the company owner, obviously.
Right. They make the owner richer. Who else?
The government. Through taxes.
Yep, the government takes its cut first, right off the top usually.
Through the mortgage and credit cards.
You got it. The employee works hard, and the owner gets rich, the government gets paid, and the bank gets paid. The employee often gets what's left.
Let's dig into the government piece, taxes. The source material seems to suggest this is a major area where financial intelligence makes a huge difference.
Oh, absolutely massive. There's a quick history lesson in the notes. Taxes on income weren't always a thing for everyone. They were originally sold as something only for the rich.
Like a soak the rich kind of idea?
Pretty much. And the general population, the poor and middle class, actually voted for it thinking it wouldn't affect them.
But then it expanded.
Of course. Soon, the rules applied to earned income across the board. But the rich, being financially savvy, didn't just complain. They looked for legal ways to minimize the impact.
And they found one.
They utilized the power of the corporation, which sounds fancy, but the source points out what is a corporation legally? It's basically just a file folder with some legal documents in it.
Not necessarily a big building or anything, just a legal structure.
Yeah, exactly. A legal entity that plays by a different set of tax rules. And this is crucial.
Why? How are the rules different for a corporation?
It flips the order of cash flow for tax purposes. This is maybe the biggest legal loophole there is. For a typical employee, the flow is earn money, pay taxes, spend what's left.
Right. Taxes come out first or very early on.
But for someone operating through a corporation, the flow is earn money, spend money on expenses, pay taxes on what's left.
Wait, They spend first, then pay taxes.
On legitimate business expenses, yes. Things like cars, travel, meals, office supplies, maybe even parts of their home if used for business. These can often be paid for with pre-tax dollars through the corporation.
So they're lowering their taxable income before the tax is calculated.
Precisely. They pay taxes on the remainder, if any. While the employee pays tax on the gross amount they earned working for the company, it's a massive structural advantage.
Okay, that's huge. So financial intelligence isn't just about earning or even saving. It's about understanding these structures.
It's a synergy, really. The source defines financial IQ as having 4 main technical skills working together.
What are they?
First is accounting. Financial literacy. You got to be able to read the numbers, understand financial statements. That's the language of money.
Okay, reading the story the numbers tell. Makes sense.
Second is investing. The science, or maybe art, of money making more money. Putting capital to work.
Got it. Making your money work for you.
Third is understanding markets.
Yep.
Supply and demand. Knowing what causes prices to rise or fall. Spotting trends or opportunities, maybe when things look chaotic to others.
Seeing value where others don't. Okay, and the last one?
Fourth is the law. Understanding the tax advantages, like we just discussed with corporations, and also how legal structures can protect your assets from things like lawsuits.
So accounting, investing, markets, and law, when you combine those,
When those work together, you don't just find money or earn money. You can actually start to invent money, create it out of opportunities.
invent money. Okay, that sounds a bit abstract. Is there an example?
Yeah, there's a great one in the source material. Back in the early 90s, the Phoenix real estate market was apparently terrible. Foreclosures everywhere.
Sounds like a bad time to invest.
For most people, yes. But for someone with financial intelligence, it spelled opportunity. They found a small foreclosed house, needed work, bought it for just $20,000.
Okay, cheap entry. Did they fix it up?
No! That's the interesting part. They didn't do any renovations themselves. They immediately turned around and sold it as is to a buyer for $60,000.
Whoa, a $40,000 profit just like that. How did the buyer pay? Did they have $60K cash?
No, and that's the clever bit. The buyer didn't pay cash up front. Instead, the buyer gave them a promissory note for the $40,000 difference, agreeing to pay it off over time with 10% interest.
So they didn't get cash, they got an IOU.
They got an asset. That $40,000 promissory note went straight into their asset column, and it immediately started paying them 10% interest, which is $4,000 a year in passive income.
From a deal that took maybe a few hours of work, finding it, negotiating.
Exactly. Maybe 5 hours total, the source says. Very little of their own money tied up. Very low risk, minimal work. They literally created a $4,000 annual income stream out of thin air using knowledge of the market, negotiation, and legal structure. The note.
Okay, that example really lands the point. Money is just an idea or the result of applying intelligence.
It really is. But if it's that straightforward conceptually, why doesn't everyone do it? Why do so many people miss these opportunities?
Good question. Is it just lack of those 4 technical skills?
That's part of it, for sure. But the source material highlights other, maybe bigger, non-technical obstacles. Things like fear, which we mentioned, and another big one, cynicism.
Cynicism, like being too negative.
Yeah, the chicken little syndrome, as the source calls it. The sky is always falling. Cynics criticize instead of analyzing. They focus on the problems.
How does that play out? Give me an example.
Okay, real estate again. The cynic hears about rental properties and immediately says, ugh, I don't want to deal with tenants and fixed toilets. That's a terrible idea.
Right. Focusing on the hassle factor.
Exactly. They let the, I don't want to shut down the analysis. The financially intelligent person might also think, yeah, I don't want to fix toilets either. But then they ask,
How can I solve that problem?
right, how much would a good property manager cost? They analyze the solution. Maybe paying a manager 10% cuts into profit slightly, but it removes the obstacle and allows them to scale. They can buy 10 properties managed by someone else, while the cynic buys 0 because they didn't want to fix a toilet.
So cynicism paralyzes, analysis empowers.
Yeah.
Got it. What other non-technical things hold people back?
Self-discipline is huge, particularly the discipline to follow Rich Dad's other key habit. Pay yourself first.
Pay yourself first before bills.
Yes. Every single month, before paying the mortgage, the credit cards, anything else, Rich Dad would take a set amount of money and invest it. Put it into his asset column.
That sounds incredibly stressful. What if there wasn't enough left for the bills?
Well, often there wasn't. That was kind of the point. He wanted to feel that pressure.
Why on earth would anyone want that pressure?
Because he knew the creditors would scream louder and sooner than he would if he was short internally. That external pressure from bill collectors forced him to think. It demanded creativity.
Forced him to go out and find or create new income streams to cover the shortfall.
Precisely. It was like a mandatory workout for his financial brain. It made him stronger, more resourceful. If he paid bills first, he'd feel comfortable, there'd be no pressure, and he likely wouldn't push himself to find new opportunities or income. He'd just stay stagnant.
Okay, that's a counterintuitive but powerful idea. Use pressure as a catalyst.
It requires real discipline, though. Resisting the urge to pay bills first is hard.
So, pulling all this together for you, the listener,
Yeah.
what's the main takeaway? If you want to move towards the rich pattern, what's the absolute priority?
The absolute priority is to shift your focus. Stop focusing solely on increasing your earned income from your job, because that income is the most highly taxed.
And start focusing on...
Start focusing relentlessly on building your asset column. Acquire things that generate passive income, like rental income or dividends, or portfolio income, like capital gains. Income that isn't directly tied to your hours worked.
And you don't necessarily need to quit your job to do this.
Not at all, especially at first. Your job provides the initial capital. The key is to mind your own business. And your business, the source emphasizes, is your asset column. Your profession is how you pay the bills initially.
So, keep the day job, but dedicate time, energy, and especially money to building that separate business, the asset column.
Exactly. Treat every single dollar you manage to put into that asset column like it's an employee. A really good employee who works for you 24/7, doesn't complain, and its sole job is to make more money for you.
Build an army of dollar employees. I like that visual.
That's the engine of financial freedom. It takes time, but that's how you eventually get off the rat race treadmill.
Okay. We've covered mindset, assets versus liabilities, cash flow, taxes, financial IQ, overcoming cynicism, discipline. That's a lot. Any final thought to leave people with?
Yeah, there's one more piece from Rich Dad's philosophy, and it's maybe the most, well, profound. It goes beyond just tactics. It's about giving.
Giving, like charity. How does that fit with accumulating wealth?
He believed deeply that to receive, you must first give, especially when you feel you're lacking something. If you feel short on money, find a way to give some money away. If you feel short on kindness or knowledge, give that.
Give what you want to receive, even when you feel you don't have enough.
Especially then, he saw it as a universal principle. What you give out comes back to you, often multiplied. It wasn't just about charity for its own sake. He saw it as a fundamental law for attracting abundance and wisdom.
So the path to wealth involves not just acquiring, but also giving. That's definitely a provocative thought to end on.
It challenges the scarcity mindset right at its core.
So for everyone listening, the call to action isn't just technical. Map your cash flow, see where your money really goes, identify assets versus liabilities, but maybe also
Find something you want more of in your life and find a small way to give that very thing away today. See what happens. It starts the flow.